Hello, everyone. Thank you for attending. Thank you for attending this new topic. We are going to talk about tax benefits, and the name is how to quote unquote depreciate your rental property. Welcome aboard once again. My name is Seewing Yee from the Yee Real Estate Network. My co-host is Miss Maureen McCann from Spartan Invest. Welcome, Maureen. How are you?
Thank you, Seewing. Nice to be here. Can't wait to dive into depreciation.
Absolutely. Yes, absolutely. And before we do that, let me share our screen. Now, before we can dive into the topic, I'm going to start off by talking to you guys out there, real estate investors out there. Rental property is the history's most powerful and proven, the most attractive, multi-dimensional, tax-favored asset class in history. And we can talk about, we have discussed many components of the rental property from time to time between Maureen and myself. But today we can talk about the depreciation and the tax benefit aspect associated with of owning a rental property. Okay, so before we begin, we have a disclaimer. Maureen, myself, we are not tax advisors. This presentation is only for educational purposes. Each individual investor that watch this video will need to consult with your own licensed tax advisor or your own financial advisor to go over your specific goals and objectives and your risk tolerance to determine what's best for you. Because real estate, just like any other asset class, there's a risk, right? There's a risk of losing principal. There's a risk of other things as well. So do what's right for you individually, but we are just giving you some nice theoretical education. So with that said, let's go over what we mean by how to quote unquote depreciate your rental property. What that mean? Okay, we'll discuss. We can use a case example, all right? And again, because we're not tax advisors, I like to use, I like to keep it simple. Okay, I like to use the KISS method, KISS.
That's what made you so successful, Seewing. You kiss everybody.
That's right. I mean, your clients do not trust you if they don't like you. They have to like you and they trust you, right? That's the whole key. Mm-hmm. So KISS means, KISS means keep it simple, stupid. Because if a real tax advisor would do this presentation, they will put people to sleep.
Oh my God.
Hopefully, we're not going to do that for the next 15 minutes, right, Maureen?
Right. Everyone has their role in life. We need our CPAs. We need our accountants. Some have better personalities than others, right? Some know more strategies than others. So you always got to align yourself with the right ones. But yeah, Seewing and I are going to deliver this info to you today.
Yeah, we can keep it at a high level, of course. And I don't want to bombard you with any kind of IRS code or those boring tax passages that we can keep it a high level from a layman's terms. Because most financial people, they don't know how to break it down to layman's terms to make it understandable. Am I right, Maureen?
Yes, we're gonna make it simple here. Let's do it.
Okay, we can use a case example of a typical property, happen to a property that Spartan Invest is promoting. This property, I've been told, is already sold recently in Alabama, Warrior, Alabama. So we can use this case example to talk about one component, which is depreciation, okay? Write-off and passive loss limitation. So this property is $147,000. That's the value of this property. So keep that in mind. Positive cash flow, what have you, that which is great, 25% down payment. That's a lot. Because using this example, so you look at the annual rent, right, of $13,200. Then you have all the debt service and expenses and mortgage payments from the underlying property. So what we're going to do, we're going to plug all these numbers: annual rent, minus all these tax deductible items, your annual taxes, insurance, property management fee, any kind of vacancies, maintenance costs, mortgage payments, and then we can identify how much tax benefit we can achieve based on depreciation, right, alone on this one property at any given year. So with that in mind, let's go over the tax return I took the liberty of creating yesterday for the purpose of this slideshow presentation. So we just plug the number from that real property into here, as you can see, right? Each year you file a Schedule E, which is rental tax schedule, supplemental income and loss. So annual gross rent before deduction is 13,200. You minus all these expenses, as I said earlier, right? Gross rent minus your debt service, which is your expenses, which is your maintenance costs, your whatever, your insurance, your property management fee you have to pay. Yeah, your mortgage interest you pay on the financing this rental property mortgage, your property tax that you pay for that year. And here's the kicker. This is depreciation. So traditionally, each property you own, you can depreciate the cost basis of your property each year. The depreciation method is for anything 1 to 4 unit is 27.5 years. So you can write off partial paper phantom write-off every year to further reduce your rental property that are subject to ordinary taxation. So now the cost basis is your property purchase 147,000 minus maybe 10 to 20% land value, since land value are not depreciable. So your purchase price minus the land value equal whatever the amount. Okay, then divided by 27.5 years. So the annual depreciation first of the 27 years is 5,444. This depreciation expense every year is a phantom write-off. It further reduces the gross income. Does that make sense? Right? So therefore, so you have 13,200 of gross rent minus your total expenses, including the phantom depreciation write-off of 5,444 equals total expenses of 17,158. So the gross income, 13,200 minus total expenses for the year, 17,158 equals your loss, paper loss, right, of $3,958, right? This is what you call a passive loss. The tax law is such that your passive losses for your rental property can only offset against passive income. Okay, keep that in mind, all right, for the most part. So let me further go into your first page of your federal 1040. Let's say you made, whether you're single or married, filing jointly, you have a total, you make W-2 income wages of 100,000. So this passive losses of 3958 for that year in question is a total write-off against your AGI, adjusted gross income. So your 100 grand of possible ordinary income being taxed are lower by the corresponding tax write-off, by the corresponding negative paper loss, which is, passive losses, depreciation, whatever, right? So 100 grand reduced just a little bit equals, 96,000 something in adjusted gross income subject to ordinary taxation, all right? That's as far as I will go, but let me give you a heads up on the passive loss rules limitations, right? If your adjusted gross income is $100,000 or less, you may deduct up to $25,000 of rental losses against earned and portfolio income if you actively participate in the management of the property. So this case such that that individual will qualify because the fact, so you can write off a lot more than 3958, but we're just using an example of one property. But if you make 100 grand or less, you can write off up to $25,000 every year of rental losses. So on using the example of 3950, you can allocate another 6 or 7 properties, right? You can add another 6 or 7 properties of annual write-off of around $4,000, and you would not be able to exceed this $25,000 of passive activity limitation per the income, right? So if you're able to buy 5 more of the rental property we just discussed, this $147,000 property, you can write off up to $25,000 depreciation to offset your earned income dollar for dollar. That means your ordinary income subject to taxation instead of 100 grand minus 25K, it would be 75,000. So if you want a 25% federal tax bracket, if you're able to write off 6 properties on the one we discussed, right? 25% of the tax bracket, 25 multiplied by 25,000, we're talking how much? Like $6,000 of tax refund back in your pocket, right? Does it make sense, Maureen?
It does. And so I think I'm just gonna tie one more little piece into this. And I think, this was very well done, and to really bring this to the listeners' attention is that the tax code is just a blueprint on how the tax code is a blueprint on what the US government wants us to do as investors to help them, right? The US government cannot feed everybody. They cannot house everybody. They cannot generate enough energy for everybody. I guess we could in the United States if we actually drilled our oil reserves. It's another topic. But what the US government tax code, what it is designed to do is to give us investors a blueprint on what they want us to do. And if we do that, and we are landlords and we house people, then guess what we get to do? We get to keep more of our money. And these are the rules to play by that Seewing showed you. So legal, real savings to us as investors. As we house people, we get to depreciate the asset and save basically that $4,000. We don't have to give to the government. The government saying, hey, thanks so much for playing by our game, by our rules. You get to keep your money.
Yep. By the way, the government want us as U.S. citizens to become rich. They want, the IRS, believe it or not, or potentially your friend, they have this tax code in place for us U.S. citizens, investors, to take advantage of. If you do it legally, you do it ethically, you do it right, you're being honest, and you'll become a real estate investor, you can apply all these great tax strategies to your situation. So let me go through the passive loss limitations. I don't want to bore you, but this is important. If you make more than $100,000 of adjusted gross income, there's a passive activity loss allowance. Any dollar you make above and beyond $100,000 of AGI, you have a 50% decreasing write-off. So the more you make between 100 grand, systematically is a dollar to 50 cents allowance. So when you reach a level of $150,000 of AGI or more, you cannot deduct any of those passive losses we just talked about. All the passive losses you accumulate, whether you own 1 property or 6 or 7 properties, if you make more than 150,000, the passive losses will be suspended indefinitely toward the future tax years to potentially apply those accumulation of year-over-year suspended passive losses to apply any future passive income you may have from your other portfolio in tax return. Does that make sense?
So it rolls over, it carries over, it carries over.
Yeah, carries over. So just because you make, our clients, many of your clients too, even though they buy in your market in Alabama, Tennessee, and Georgia, come from California, right? We have some high income individuals that makes more than 100 grand, that makes more than 150 grand. Does that mean they should not buy rental property because they cannot get any passive write-offs? No, they can still buy those rental properties because you're getting the other multi-dimensional gains out of it, which we discussed, which is appreciation, cash flow increased, debt write-off and all those kind of things. But even if you do, that's all you know, it's okay. Get the suspended passive losses for the future, because in the future, when you accumulate a whole bunch of passive losses, if you sell any of your properties in the future, you may not need to do a 1031 tax-free exchange. You can apply all that chunk of accumulation of passive losses over time. When you sell your property, which is subject to capital gains, you can apply those passive losses against the tax on capital gain that will further totally eliminate or drastically decrease your capital gains in the future because of your accumulation of passive losses, right? So does that make sense, right?
It does. And who wants to pay less in taxes? Say I.
I and everyone else out there.
Yes.
So I know this is as we conclude this short presentation, we're just showing you one aspect of the tax benefit associated with getting a rental property. One more thing I almost forgot. There's another topic I should have used another video, but it's called cost segregation. Have you heard of cost segregation? Now, again, consider your tax advisor as always. You remember the value of the property divided by 27 and a half years, right? I mean, nice and slow process, you get the annual benefit, whatever. But if you can do a cost segregation, you can hire a tax advisor or some kind of a financial professional. There are some companies out there, all they do is do cost segregation, whereby they go through the cost segregation expert will go through each property and identify what property inside the house or can depreciate over 5-year time frame, over 10 year, over 15 year, instead of lump the whole house together into 25 and a half years depreciation, which is good, but 25 and a half depreciation write-off is kind of small, right? So
you can compress it, yeah. So you can compress it in a short period of time.
So a 5-year accelerated depreciation, you can write off over 5 years or 10 years or 15 years, you get more immediate write-off, right? More passive losses, right? So what again, I'm only give you a high level explanation. A 5-year asset inside the structure could be a washer and dryer, right? Could be a boiler or air conditioner, right? A 10-year asset structure could be a landscape outside, could be a patio, could be the foundation of a roof, right? Could be a furnace, 10-year depreciation method. So you accelerate, you do cost segregation to break down components of a house, of a structure. You could potentially allocate 30%, maybe 50% of the entire cost of the house to become a 5 or 10-year accelerated depreciation method. So you can get more passive losses in a given year. So instead of the example that we use on this one property, $3,958 of passive losses, if you apply the cost segregation strategy, you could potentially claim $15,000 of passive losses annually because of the cost segregation method. Does it make sense?
It does, and it's a really good strategy for those investors out there that maybe they've got a good. I can think of one of my clients. He did really well on a stock. He was a startup company, did really well on the stock, and he was looking at selling the stock, and it was going to be about $800,000 in profit to him. And so, he's got a large portfolio of rental properties, single family. And I suggested the cost segregation strategy to him to offset some of those. If he sold, when he sold, he knew he was going to have a large taxable event. So this was a strategy that I had introduced to him that he could use to help offset that big tax bill in that year that he sold stocks.